Okay, so in this video we're going to be looking at another supply side factor called real unit labour costs. So I said in the last video that productivity has nothing to do with the price of labour, it's just the output per unit of input. Now we're going to talk about something that is more relevant to prices or costs of labour. So costs of labour, whenever you're talking about the cost of labour, you're not just talking about the producer's wage, it also includes any superannuation you have to pay to the consumer, the consumer's wage. It includes any superannuation you have to pay to the consumer, any work cover expenditure, so to cover them in case they get injured, any taxes you have to pay. So every time, if you own a business, if you employ people, you have to pay tax for every worker that you have as well. And it also includes any sick leave entitlements that they get access to. So we're talking about all the costs involved with employing a person. So essentially, when we're looking at businesses, we don't want our labour costs to increase without increases in productivity. So if every year wages are going up by 5%, but firms aren't becoming any more productive, well, that's not very good because it's going to eat into their profit margins and increase their production costs. So it's essentially the aim of businesses to increase their labour productivity at a similar rate to the increase in the average cost of labour. So when you use the term unit labour cost, that is a measure of the average cost of labour divided by average labour productivity. So if, say, costs of labour are going up by 5%, but average productivity was going up by 5%, then your unit labour costs would stay the same. Okay, so unit labour costs will fall unit labour costs, again, we're looking at a ratio, so you need to be able to think about all the things that are going to lead to lower unit labour costs. So unit labour costs will fall if labour costs fall but productivity stays the same, because your numerator will go down while your denominator stays the same. It'll also fall if productivity increases without a change in labour costs. So if labour costs stay the same but productivity increases, then we're going to have lower unit labour costs. It will also fall if labour productivity increases more than an increase in labour costs. So if labour costs go up by a little bit, say 2%, but productivity goes up by 5%, then your unit labour costs will fall. So basically we're saying that the denominator is going up by more than the numerator. Okay, so they're both going up, but this one's going up by more. And if they both fall, but labour productivity falls by a smaller margin than a decrease in labour costs, so if productivity went down by 2%, but labour costs went down by 10%, again, unit labour costs will fall. So you need to be really aware of all the things that can cause a fall in unit labour costs. 1, labour costs fall. 2, productivity increases. And then 3 and 4, productivity increases by more than labour costs increase, or productivity falls by more than labour costs fall. Real unit labour costs is exactly the same as unit labour costs, but it takes into account the impacts of inflation. So it's the average cost of labour adjusted for inflation divided by average labour productivity. So generally, real unit labour costs will go up at a smaller rate than unit labour costs because we're adjusting for inflation, and therefore basically this figure here is going to be lower than your average labour costs because we take out the impacts of inflation. So if inflation grew by 2%, we would take out that 2% increase just to see if the average cost of labour is increasing in basically real terms. So higher rates of labour productivity reduce real unit labour costs, but not all reductions are caused by higher labour productivity. Okay, real unit labour costs may fall because labour costs have fallen. Higher real unit labour costs is an unfavourable supply side factor because it will reduce our profit margins and discourage productive activity. So if this thing is increasing, it's going to make it more costly for businesses to produce because it's costing them more per hour. It's costing them more per unit of output. It's going to discourage productive activity and reduce aggregate supply. If our real unit labour costs are going up lots, then that's likely to lead to reduced international competitiveness, inflating prices and reducing exports. So whenever we talk about labour costs increasing, so say we're in a tight labour market, that's going to lead to higher real unit labour costs, assuming productivity stays roughly the same, and that's going to reduce our international competitiveness. It's one of the reasons why during the mining boom, manufacturing was less competitive because they had to pay higher wages, and therefore they lowered their real unit labour costs. And that's going to lead to reduced international competitiveness, higher prices, reduced exports, and lower income. So again, like with productivity, you want to make those links to aggregate demand. Even though it's a supply side factor, higher real unit labour costs will hurt our international competitiveness, lead to lower employment, lead to lower incomes, and lower real GDP per capita. A couple of tricks to make when you're looking at unit labour costs. So this first graph is unit labour costs. And again, basically what happens is if this orange line is above the green line, then unit labour costs are going to be going up. So you can see at this point here, the green line just goes above the orange line, and therefore unit labour costs go below zero. And it's the same here. They start to be close together, and therefore unit labour costs fall below zero, because productivity is increasing faster than average earnings per hour. A couple of tricks with these. Don't be the person that says that unit labour costs are falling, like at this point here, or at this point here. They're still above zero. They're just not increasing at a rate as fast as last year. Unit labour costs are only falling if they're below the zero line. Okay, so throughout this whole period in here, unit labour costs never fell. So from 2002 to 2008, unit labour costs increased every year. Actually, basically from 1998 to 2008, unit labour costs increased every year. Labour supply is greater than labour demand. If we have a really soft labour market or a weak labour market, it's likely to lead to lower labour costs and less wage pressures. And that's why real unit labour costs are around zero at the moment, because wages aren't increasing at a very high rate. And that's a supply side factor that's helping our growth at this point in time. A very relevant supply side factor in 2016. Okay, so the impact on growth rates, just to finish off, of increased real unit labour costs. It will increase costs of production for businesses and lower their profitability and lead to unfavourable supply side conditions. Businesses are essentially less willing to produce because they're going to be making less profits. A decrease in real unit labour costs is the opposite. It's favourable. It will decrease production costs per unit of output, increase profitability, and make firms more willing to produce. So that's the start of your answer, linking it to supply, linking it to production costs, linking it to the willingness of businesses to produce. Okay, lower production costs, higher willingness to produce if we have lower real unit labour costs. Then, if you get asked to start to discuss the link to growth, you want to talk about the indirect impact to aggregate demand. So lower real unit labour costs will help to reduce inflationary pressures, helps to stimulate consumption expenditure because people want to buy Australian products. It boosts investment expenditure because firms are going to be making more money, they're more profitable, and it will boost net exports because our exports are cheaper. And this will all lead to an indirect expansion in aggregate demand. All these things will increase because of the lower price. Okay, it's not a shift in demand. It's again, I'll just quickly draw the curve. It's an expansion in demand that's caused by a lower price. Okay, and therefore, we're now at a higher real GDP than we were at this point here because we're further along to the right. Thank you.